So next up, we've got the best ideas, as promised, the speed presentations from some of the other boutiques who run Australian equities. I'll just get the guys to come up on the stage. While they're doing that, I'll introduce the first speaker, John Campbell, Managing Director and Portfolio Manager at Avoca Investment Management. They run a small cap strategy. They've got a large insto book of clients. They also have a retail trust here in Australia, as well as they've got a SIV set up for microcaps as well for those Chinese investors as well. So without further ado, I'll pass over to John. Thank you.
So the idea of these 5-minute things are to allow each of the boutiques to sort of showcase how they think about stocks and what characteristics they want their portfolios to exhibit. So Avoca is a style-neutral Australian equity small-cap manager, but we err very much towards the value end of the market. We don't like to pay extraordinarily high PEs unless there is a compelling long-term growth story with what we think is a strong and defendable moat. And I guess it's true to say that ever since the GFC, valuation overlays have been fairly unfashionable, with interest rates plumbing record low levels. But we think they will come back into fashion as the inevitable normalisation of interest rates runs its course, and as Neil indicated, PE multiples start to fall. So with that as the backdrop and context, I've chosen Austbrokers as the company that I'll showcase. Austbrokers is a significant position within our fund, as you would expect. Austbrokers is a domestic SME insurance broker. It offers general and life insurance broking services, as well as other ancillary services. So this slide highlights 9 disruptive forces that are at play in insurance at the moment. Technological disruption is a concept at the forefront of investors' minds these days, and it certainly is a big consideration within the insurance sector. The immutable law of disruption is that it is almost always a significant negative for the incumbents. So these 9 technological and societal changes that are underway in insurance, some of them include things like price and value comparison websites. So you'd all be very familiar with iSelect, Compare the Market, and a myriad of others. That's leading to lower prices for retail insurance products in the main. That's the whole purpose of price and value websites. Telematics, which facilitates the flow of data from connected devices to the insurer, and this is also allowing new and nimble competitors to spring up. Peer-to-peer insurance, that allows customers to bypass the insurers, the traditional and incumbent insurers for some, or in some cases, all of their needs. And the final one I'll mention is the impact of the sharing economy, which overall is just driving down the demand for insurance services. So these forces are changing the face of insurance and have certainly facilitated new entrants that aren't burdened by legacy systems and processes. But critical to our thesis on Austbrokers is that we believe that whilst the disruptive forces are going to be range from significant to potentially existential threat to underwriter incumbents, we believe they'll prove pretty immaterial to the SME broking sector. So I think everyone in this room should be pretty familiar with what this slide is all about. What it shows is that a typical SME, typical small or medium-sized enterprise, requires many forms of insurance, ranging from property insurance, professional indemnity, and more recently to cyber insurance, which is becoming more and more critical. And in fact, a typical SME could require something like 10 or even more different insurance policies. That SME might have a CEO and a CFO and maybe 1 or 2 other admin staff, but in the main, human resources are very limited. And whilst insurance is mission critical to SMEs, it's also a highly specialised function, and most SMEs, as you would think, are so strapped for human resources that they're very happy to cede this function to a broker. You get expert advice, you get the buying power of a very large buying group, and you get vastly improved claims process. So it's a genuine win-win. So accordingly, we see overall the industry dynamics within the insurance broking sector as likely to remain relatively unchanged going forward. This gives us robust confidence in Austbrokers' long-term future. As the economy grows, Austbrokers will grow and shouldn't be disrupted. So that's our sort of thesis on Austbrokers, but back to the unfashionable valuation metrics. It's on a PE of 18. It'll deliver EPS, 3-year compound EPS growth of somewhere between 12 and 14%, and it's currently yielding just under 4%. So, going back to Neil's metrics, you add the 12 to 14% EPS growth plus the 4% yield, you're getting something that's going to be, approaching that 20% level of BAEP. Not quite as good, but maybe it'll get a little bit of PE expansion because the starting PE isn't too high, and that's an important point. So overall, we see these valuation metrics as superior to the average small industrial on all counts, and we've got a huge amount of confidence in this company as a long-term portfolio hold. So that's it. Thank you.
Beaumont from Bennelong Australian Equity Partners. As Julian works with Neil Goldster-Morris, one of the earlier speakers, they're up for an award at the Money Management Lonsec Awards in May, and good numbers, but also run a core strategy, the X20 fund that's pretty well known, and also the concentrated, and also a microcap that's recently been launched. So, Julian, your best ideas. Thank you.
We've got a stock here that we own within the portfolio. It's called BWX. It's one that's actually done quite well for us, having bought it on a pre-IPO basis back a couple of years ago. Since then, we've supported it into a listing on the stock market and has subsequently supported and championed it with extra capital and support. It's delivered good returns for our funds in the order of a 5-bagger, but more recently it's presented an opportunity for investors. Having put down a reasonably soft result, the market penalised and exaggerated that softness into a share price retraction. And at this point, we think it's very attractive. And you might be able to see from the ASX disclosures that we've actually added to our position in the portfolios for it. BWX, it's a company not well known. It's actually a supplier of skincare creams and other personal care products. Its main product brand is called Sukin, and as you can see from this graph, it's actually got a very strong market position in Australia. So Sukin itself occupies something of a niche in the market space in that masstige $10 to $20 price level, but also in the leader in the organic space, which is the faster growing sub-segment of the skincare market. So it has a larger position in terms of its sales through the pharmacy channel than the likes of L'Oreal, Nivea and Garnier that probably people are more accustomed to. And as this chart shows, not only is it a higher market share, but also it's gaining market share as reported from the last ACN Nielsen data. And that really goes to the momentum behind the business, the customer attraction to the brand and its growing popularity. The product itself is reasonably defensive. It's of that predictable nature. Vanity tends to be pretty resilient to the economic cycle, and it tends to actually grow quite nicely. The economics of the business are really strong. The ingredients in skincare cream, surprisingly, aren't that great. The gross profit margins are very strong, and so this accelerated growth really translates into strong value creation. Now, the interesting thing for Sukin is not only are they growing strongly in Australia through other products, including some other brands, range extensions, including to baby care, skincare and men's brands. You can notice that I'm looking pretty good at the moment. But also they've moved into other distribution channels, and principally in Australia that has been through the supermarket channel. The pharmacy channel was half of the market. They've now moved into Coles, which reflects the move into the other half of the distribution channels in Australia. And more importantly, from a longer term perspective, they're going offshore. Now, about half of their business comes from Australia, but increasingly that their sales are growing in the international markets as they continue to put more and more flags down. They've been in the largest pharmacy chain in the UK, in Boots and other operators there. They've moved strongly into Canada, into China, and increasingly putting their flags down in more and more countries. In addition to that, they've actually made a number of acquisitions, including, for example, in the US of the largest organic cosmetic brand, Mineral Fusion, as well as a couple of other acquisitions that really fill out their portfolio, provide them other products to put down their distribution channels globally, as well as other products to bring back into a stronger Australian market. So the opportunity really now, as I said, comes down to some weakness in the share price that we're currently seeing off the back of a softish result. We believe, based on our research and analysis, that the market very much exaggerated that softness into the share price reaction. Currently trades in the order of about 21 times forecast earnings, and we think that there's very conservative expectations in the market for growth for this upcoming year, the next year, and the longer term growth opportunity going forward. So I'll just leave it at that and pass across.
So next speaker is Jack Gemello. Jack is the founder and investment director at one of our newer boutiques, so Touchstone Asset Management. They're another Australian equity manager, slightly different, growth at a reasonable price is their style, high conviction. So I might pass over to Jack just to share his best ideas and tell us a little bit more about Touchstone as well. Thank you.
Touchstone Asset Management is a JV that kicked off or formed in 2015 between myself and my two investment partners, who unfortunately can't be here today, Sue Ellen Morgan and Mary Ferros, and obviously Bennelong Funds Management. We're a concentrated index unaware manager. That's our sole focus. We run a concentrated Aussie share fund with between about 15 and 25 stocks, currently around 22. And we build that portfolio, construct that portfolio without reference to the benchmark, largely because of the distortions and concentrations of risk in that in the Aussie benchmark. If I were to describe our philosophy, indeed what sort of underpins our process, we refer to ourselves as QARP, or quality to reasonable price investors. And the context there is what we're about is trying to identify quality businesses, and by quality, what I mean are companies that have above average return profiles that we think are enduring. And we try and invest in those businesses at what we call reasonable prices, or that what we really mean are valuations that sort of allow good returns or expected returns to the investors in our funds. So it's about marrying up those two factors, so quality and reasonable price or value. That's ultimately what underpins what we do at Touchstone. And if I can quote, perhaps the most famous investor of all time, Warren Buffett, he once said that price is what you pay and value is what you get. And that's a really important point for us, and something we subscribe to, really significantly, because ultimately we know that there is a link or a relationship between the price that you pay for a security and the returns that potentially that security generates. That's not to say that other factors don't affect it. Of course they do, but price is a significant factor, and it's something we pay a lot of attention to, as well as quality. As I said, we kicked off in 2015, so we've been around a couple of years. Our focus has largely been on the institutional market up until now, and that's probably a function of the backgrounds of the three of us. I spent in the order of 15 years at BT, Bankers Trust and then BT, and Sue Ellen and Mary sort of formerly from 452. And we've sort of been successful in attracting some really good institutional support with that focus and some assets. And for us, that was really important to sort of get to a position where we could come to these sorts of forums for the first time in a strong position, having sort of scaled up the business and ready to focus on the opportunity on the retail side. And so whilst this is one of the first times myself or either of my partners have appeared at one of these sorts of forums. It certainly won't be the last. And I should just add, in sort of completing the background view of us, we did set up a retail fund, which is coming up to its 2-year track record next month, so that is available as well. With that, I believe I have the controller. I will move on to one of our favourite ideas from our QARP, or Quality at a Reasonable Price process, and that's Goodman Group. And what you're looking at on the screen there is a large distribution centre that Goodman built for their second biggest client in the world, being Amazon, and that facility is in Germany. So by way of background, Goodman Group, and many of you probably already know this, is a player in the property, a diversified player in the property business, focused on the logistics part of the industrial property sector. So when we talk about logistics, what we're talking about is the part of industrial property that's really sort of focused on, or I guess essentially provides the backbone for e-commerce. It's an enabler of e-commerce globally. Within that segment, Goodman play right across the value spectrum. So everything from the development of those sorts of assets, and that's an asset that Goodman will have developed and did develop, to the ownership and operation of those assets, property services around those assets, and really importantly and increasingly over time, funds management relating to those assets for some of the largest pension funds and institutional investors in the world. It's a tier one strategy, and by tier one, what we mean is it's focused on the largest, best located logistics assets, which are often closely located to large population centres around the world, and that's really important in a delivery sense to the end customers of those online sales. It's also focused on gateway cities, and that's a term that's come to mean sort of the key cities that support, or the key ports, if you like, that support, in an import and export sense, countries or economies in a globally connected world. So why do we like it? Well, firstly, in our opinion, Goodman represents a really high quality company based on our Quality at a Reasonable Price, or QARP process, and it's one of the very few ways to play the very rapid growth in e-commerce from within the Aussie market, and clearly it's not a technology company. If we were to dimension the opportunity, just to step back for a second, we're talking about, the theme here is global, at a global level, retail disruption, so it's obviously a very large opportunity. If we were to go to just the readily available market forecasts that are out there for online sales growth, what we see are projections that suggest online sales grow to around about $4.5 trillion by 2021. So that's really strong aggregate growth in the vicinity of 96%, sort of between now and then. If I were to contrast that with traditional bricks and mortar retail sales, over the same time frame projected to grow by only around 25%, so only a fraction of the growth. So it's really that's the heart of the thesis, and what we really like about that really strong growth in e-commerce that's feeding through and driving very significant demand for the sorts of assets that Goodman have focused on, like you see up there on the screen. If we look at how it's feeding through at the company level, ultimately that's what we invest in. I went back and had a look at the 5-year growth rate in Goodman in assets. Over the last 5 years, assets have grown by about 11% per annum. Not a bad growth rate, but sort of not exceptional. But that's only half the story, because over that same 5-year period, Goodman have undertaken the largest divestment program in their corporate history, whereby they've sold down all of the assets that don't really fit that tier one gateway, a significant proportion, I should say, of assets that don't really fit that tier one gateway strategy, about $11 billion worth of assets over that period of time. So they've sort of become a leaner and more focused organisation, really doubled down almost exclusively, you could say, on that e-commerce opportunity now. And so what's probably more important there is the underlying growth. If we look through those sales, and over the last 5 years, that's been around about 17% per annum. So, really strong growth coming through from that big thematic. So I think that ultimately, in terms of summing this up, we think that growth can continue. I mean, not at 17% sort of growth, but still really strong growth, and not just over a 1 or a 2 year time frame. What we're really looking at here is fairly early on in the innings. To use a baseball analogy, maybe the second or third in terms of this e-commerce opportunity. So really strong growth over not just 1 or 2 years, but 3 to 5 years and 10 years and beyond. So if I was to sum that up, we see Goodman as a really high quality way to play, what is disruption at a global level from the Aussie market. Hopefully that gives you a little bit of a background on who Touchstone are and one of our favourite ideas from our process. Thank you.
Thanks.